All right, welcome. Today we are going to pull back the curtain on one of the most powerful tools in finance, options. But don't worry, we're going to skip all the confusing jargon. By the end of this, you'll know exactly what call and put options are all about. So let's just dive right in.
To really get a handle on options, let's just forget about the stock market for a second. Let's talk about something we can all relate to: buying a house. So picture this: you find your dream house. It is absolutely perfect. The only catch: you're not quite ready to buy it today. But what if? What if there was a way to lock in today's price for later?
So you go to the owner and you make a deal. You say, look, I'll pay you $5,000 right now, non-refundable. And in exchange for that cash, they agree to give you the right to buy their $300,000 house anytime you want over the next year. Now think about what you just did. You haven't bought the house, you've bought the choice.
Okay, so that $5,000 you paid, that has a name. In the world of options, that's called the premium. It's just the fee you pay for the contract, for the right, and this is key, the right, but not the obligation, to make a decision down the road.
And what about that $300,000 house price you locked in? Well, that's what we call the strike price. It's the set price you get to buy at, and it doesn't matter if the housing market goes crazy and the house is worth $1 million later, your price is your price. It's set in stone.
And last but not least, that one-year deadline? That's the expiration date. See, every option has a clock on it, a shelf life. You have until that date to make your move. So let's recap. You paid a premium for the right to buy at a certain strike price before the expiration date. See, you've already got the lingo down.
Okay, so we've got the basic terms. Now let's take our little house story and plug it into the stock market, starting with the first type of option.
Remember that deal you made for the house, the one that gave you the right to buy it at a set price? Well, in the stock market, that's called a call option. It is the exact same idea. It's a reservation to buy something later.
So, let's just lay it all out. A call option gives you the right, again, not the obligation, you're not forced to do anything, to buy a stock at that set strike price any time before the expiration date. Now, why would you do this? Because you are betting the stock price is going to go up. You're bullish.
So this is where it gets exciting. Let's jump back to our house. Imagine the real estate market takes off, and that dream house is suddenly worth $350,000. But wait, you have a contract that lets you buy it for $300,000. All of a sudden, that $5,000 piece of paper is incredibly valuable, right?
But what if the opposite happens? What if the market tanks and the house is now worth only $250,000? Are you going to use your right to buy it for $300,000? No way. And you don't have to. You can just walk away. And what did it cost you? Just that $5,000 premium you paid. Your risk was capped from the very beginning.
And this really gets to the heart of why people buy options. Your risk, your potential loss, is strictly limited to that premium you paid up front. That's it. But your potential profit? Well, if that stock price goes to the moon, your profit can be way, way bigger. It's what they call an asymmetric risk reward.
Okay, so that's a call option. It's your right to buy. But what if you're worried prices are about to fall? What if you want the right to sell? Well, that brings us to the other side of the options coin, the put option.
Let's flip our whole story around. This time, imagine you already own that $300,000 house, but you're getting nervous. You're hearing rumors the big employer in town is leaving, and you're worried your home's value is about to take a nosedive. You need some protection.
And that is exactly what a put option is for. Honestly, the easiest way to think about it is like an insurance policy for your stock. A put gives you the right to sell a stock at a locked-in price, which can protect you if the price starts to fall.
So a put gives you the right to sell a stock at the strike price before the expiration date. You'd buy a put when you are bearish, when you think the stock's price is headed down. And if you're right and the price drops, your right to sell it at that higher, locked-in price becomes more and more valuable.
All right, so we have our two main players, calls for buying, puts for selling. And really, it all boils down to one simple question. Which way do you think the stock is headed, up or down?
Let's put them side by side, just to make it crystal clear. Calls give you the right to buy. You're bullish. You want the price to go up. Puts give you the right to sell. You're bearish. You want the price to go down. And here's a little trick to remember it. You call up a stock and you put down a stock. Simple, right?
Let's use a real example. Let's say you think Tesla is about to crush their earnings report. You're bullish. So you might buy a Tesla call option. If you're right and the stock price explodes upward, the value of your option to buy it at that lower price is going to shoot up too.
Or, on the flip side, maybe you're worried Apple has some tough new competition. You're bearish. So you buy an Apple put option. If the stock does end up falling, your right to sell it at that higher, locked-in price becomes more valuable. You profit from the downward move.
And really, that's the whole foundation. Believe it or not, you now understand the absolute bedrock of the entire options world: calls and puts. Every single complicated strategy you'll ever hear about is just built from these two simple pieces.
So, let's just make sure we've got the key takeaways burned into our brains. You think a stock's going up? You look at calls. You think it's going down? You look at puts. Either way, you're buying a choice, a right, not an obligation. And maybe most important of all, the absolute most you can ever lose is the premium you paid to get in the game.
So there you have it. You've got the essentials. The right to buy with a call, the right to sell with a put. These are the fundamental tools for making a bet on where the market's headed. The only real question left is, which direction will you choose? Thanks so much for tuning in.